A delayed annual report has had Supermicro's stock in a lot of volatility this month, but hasn't reached its bottom yet. Here to dive into where this stock is at right now are MarketBeat analysts Chris Markoch and Thomas Hughes. Thomas, you had an article this week about where SMCI stock stands right now and whether or not we're close to that bottom. What do you think we are at right now, Thomas?
Well, I think that there's still some risks, but I think that the stock is at or very near its bottom. If you look at the chart, the sell-off since the peak earlier this year, it shaved 65% off of the stock price, but it's retraced almost 100% of the rally that occurred this year, which to me is a bubble. It was an AI-driven bubble. The market got ahead of itself, started to sell off as some expectations were reset. That sell-off was accelerated by a short report over the summer. But now we're back at these levels where the stock was very attractive last year. It's in a hot market. It's still growing, so it should still be an attractive stock today.
And Chris, I think we're seeing a little bit of that in the market right now. What has the stock done most recently in the last few days?
Well, what we've been seeing since about a little bit after Labor Day, let's just say, is the stock is starting to go up a little bit. Like Thomas said, I think there's some buyers that are starting to look at this and saying it's overdone. I think Thomas made a really good point in saying there was probably going to be a sell-off in the stock when you saw how high it had gone in such a short time. 65% drop is not just because of a short selling report. I mean, that especially when we don't really know what the details of that report are.
Well, right. And the sell-off really began before the short report came out. The short report really just accelerated, push it down to the bottom. It was a resetting of expectations. And then the earnings over the summer margin was a little bit weaker than expected, and that gave the market some reasons to fear. So it is kind of a combination of factors. But again, the stock has retraced back to these levels where it was attractive before the market created a bubble. So we have to ask ourselves, has anything really fundamentally changed for the business? Because if it has, it could go lower. But if it's still in a strong industry, it's at a good price, it should begin to rebound, and next year should be a solid year for the market.
Well, I think that question is what has a lot of investors having some caution right now. There is some uncertainty and some people questioning that report that both of you just mentioned. Thomas, let's dive into what's the issue with this delayed report and what are some people speculating?
Well, right. So the report was delayed. It's the end of the year filing, and it was delayed. We don't really know why, but I assume, given the benefit of the doubt, that it is just an overabundance of caution. The Hindenburg short report certainly raised some doubts about the company's financial reporting. There has been some history in the past of some misrepresented numbers, but that was years ago. We have to assume the company has moved on from that, and that once the finalized report comes out, a lot of those fears will be alleviated.
Chris, do you have any concerns about the report delay?
I don't. What I would be more interested in going forward is going to be hearing about one concern that was brought up in the Hindenburg report that was outside of the financials is potentially that Supermicro is understating the competitive pressures, that there are some Supermicro customers that are aggressively looking for lower cost alternatives that they feel might have better quality. If I'm an investor looking to buy the stock, that's something that might concern me a little bit more than accounting irregularities, which I agree with Thomas. I think this delay is probably being done out of an abundance of caution to make sure that they've got the numbers right. And I don't necessarily think that's going to be the reason why you should stay out of the stock right now.
Thomas, you already alluded to this, that there's just as much of a risk the stock could go down as it could go up. It just depends on the solidness of the industry. But Chris, you just brought up an interesting point. The competition, is that part of what we're seeing with the stock price, is that there's just more competitors and more saturation of the AI market and what Supermicro is providing?
I don't know if that's the reason yet, but I would say that could be an issue going forward. I mean, when Supermicro reported earnings, they also said that they're not seeing any slowdown in demand from NVIDIA, which is one of their biggest customers in terms of the data center market. So that would seem to be good. However, that's also maybe the type of thing that the Hindenburg report is trying to question. The answer that I have for you, Bridget, is I just don't know. And that would make me a little bit hesitant to get in right at this moment on Supermicro, but it doesn't necessarily mean it's not a good stock to own over time. It's just maybe I don't want to jump in right now.
Right. Right. What Chris is saying plays into the idea that there may be volatility over the next few weeks or months. Like the proof in the pudding will probably come out with the next earnings report when they deliver or don't deliver on what the expectations are. Right now, the market is expecting about 200% revenue growth in the next quarter, which is substantial. It's huge. However, it does align with NVIDIA's own ramp in revenue over the last couple of years, and you have to think there's some correlation between the two. And also, the analysts have been lowering their targets, so it's a low bar. The company could very easily outperform, and even if it just reports in alignment with the consensus, the whisper numbers are below consensus, so that would still be a strong report. All that said, I think that the Q2 report could be a catalyst for higher share prices.
Let's move on to short interest a little bit. You talk about that in your article too, Thomas. What's the concern there?
Right. So the short interest is a big factor in the stock price right now. I mean, the short report from Hindenburg was matched by another short report by another short selling firm. Short interest is up at 15%. They certainly took advantage of the report to help drive the stock back to these lower lows. But again, at 15%, there's ample fuel for a short covering rally and a short squeeze. So all we need is some good news to come out, and the stock could not only just move higher, but rocket higher. All right. So again, pulling it back to the near term and volatility, high short interest, fighting against a bullish outlook is going to provide volatility. So I would certainly expect to see the market make some whipsaw moves throughout September and possibly into October and maybe through the end of the year.
I'm hearing a lot of volatility. Expect a lot of changes quickly, especially in the short term. Let's talk about what this stock could look like for investors long term.
Well, long term, you have to assume that the peak set earlier this year is the market pricing in the best case scenario. So if we get a best case scenario in the results, we can see the stock climb back up to retest those highs. Otherwise, I see the stock advancing, possibly even, where are we at? Possibly even doubling or more in price over the next 12 months to 24 months. But setting a new high could be difficult without some other catalyst for the outlook.
That's some great information for our viewers to consider when they are looking at buying SMCI. Thank you both for diving into this company and this stock a little bit more today. We'll continue to follow this stock and many others right here on MarketBeat. As always, happy investing.